In 2026, the United States government will face a financial event that most people have never heard about, but investors are watching it very closely. Over $7 trillion of U.S. government debt will need to be refinanced in a very short period of time. To understand why that matters, we first need to understand how government debt actually works. The U.S. government does not borrow money once and then pay it off slowly over decades. Instead, a large portion of its debt is constantly rolled over. Treasury bills, Treasury notes, and Treasury bonds all have different maturities. Some expire in just a few months, others last for years. When those securities mature, the government does not usually pay them off with cash from savings. Instead, it issues new debt to replace the old debt. This process is called refinancing. And most of the time, markets absorb this new debt without much trouble. But 2026 may be different. According to Treasury projections and market estimates, roughly $7 trillion of U.S. debt will need to be rolled over during that period. That means the government must find buyers willing to lend enormous amounts of money again. Why could that be a problem? Because interest rates today are dramatically higher than they were just a few years ago. In 2021, the U.S. government could borrow at extremely low rates. But after the inflation surge and aggressive Federal Reserve rate hikes, borrowing costs have increased sharply. Higher rates mean the government must offer more attractive yields to investors, and that increases the cost of servicing the national debt. Already, the United States is paying hundreds of billions of dollars per year just in interest payments. If refinancing occurs at higher rates, that cost could rise even further. Another factor is demand. For decades, global investors have eagerly bought U.S. Treasury securities because they are considered one of the safest assets in the world. Central banks, pension funds, insurance companies, and global investors all hold Treasuries. But the global financial environment is changing. Some countries are diversifying reserves away from U.S. assets. Others are increasing domestic investments. Meanwhile, the U.S. government continues to run large budget deficits. So the question investors are asking is simple. Will there be enough buyers for this wave of new debt? If demand remains strong, the system will function normally. But if demand weakens, the government may need to offer higher yields to attract buyers. And higher yields can ripple through the entire financial system. Mortgage rates rise. Corporate borrowing becomes more expensive. Stock market valuations may adjust. Even the global financial system can feel the impact. Because U.S. Treasury securities are not just government bonds, they are the foundation of the global financial system. Banks use them as collateral. Investors use them as risk-free benchmarks. Central banks use them as reserve assets. So when something changes in the Treasury market, the effects can spread everywhere. Now, this does not mean that a crisis is inevitable. The United States still has the largest and most liquid government bond market in the world. Demand for safe assets remains extremely strong. But the scale of the refinancing wave in 2026 is unusual. $7 trillion is not a small adjustment. It is a massive test of market demand. And that is why analysts, economists, and large institutional investors are paying very close attention to what happens next.
When people hear about the U.S. national debt, they often imagine a single giant number growing year after year. But the real story of government debt is much more complex. The U.S. debt system is constantly moving. Treasury securities are issued, mature, and then replaced with new ones. And that cycle is about to face one of its biggest stress tests in modern financial history. In 2026, the United States may need to refinance roughly $7 trillion of debt. That number alone is difficult to visualize. $7 trillion is larger than the entire economy of many developed countries. And refinancing that amount requires global financial markets to absorb enormous volumes of new Treasury issuance. To understand the significance, we need to look at how the Treasury market works. The U.S. government finances its spending by issuing Treasury securities. Investors buy those securities and lend money to the government. In return, they receive interest payments and repayment at maturity. The buyers include banks, pension funds, investment funds, insurance companies, and foreign governments. For decades, Treasuries have been considered the safest financial asset in the world. But in recent years, the environment has changed. Interest rates have risen dramatically. Inflation has forced the Federal Reserve to tighten monetary policy, and global investors are beginning to reconsider how they allocate capital. Higher interest rates mean the government must offer higher yields when issuing new debt. That increases borrowing costs. And when trillions of dollars must be refinanced at higher rates, interest payments can increase quickly. In fact, interest expenses are already becoming one of the fastest growing components of the federal budget. At the same time, the U.S. government continues to run large fiscal deficits. That means new borrowing is required even before refinancing existing debt. So markets may need to absorb not only the refinancing wave, but additional deficit spending as well. This raises an important question. Who will buy all this debt? Domestic investors remain strong buyers. Pension funds and banks rely heavily on Treasury securities. But foreign demand has become less predictable. Countries like China and Japan historically held large quantities of U.S. Treasuries. However, geopolitical shifts and changing financial strategies may influence their future purchases. If foreign demand declines while supply increases, Treasury yields could rise further. And higher yields affect everything from housing markets to corporate financing. Because Treasury yields serve as the benchmark for many other interest rates in the economy. When those rates move, the entire financial system adjusts. Still, it is important to remember that the Treasury market remains extremely deep and resilient. Even during periods of financial stress, global investors often move toward Treasuries rather than away from them. But the refinancing wave expected around 2026 represents a rare moment when supply pressure could test that resilience. And that is why economists, central banks, and market participants are closely watching the years ahead.
Global financial markets depend on a foundation that most people rarely think about. That foundation is the U.S. Treasury market. Treasury securities are used as collateral in financial transactions around the world. They help determine interest rates across global markets, and they serve as the benchmark for pricing countless financial assets. But even the strongest financial systems can experience periods of pressure, and in the coming years, one of those pressures may come from a massive wave of debt refinancing. Estimates suggest that around $7 trillion of U.S. government debt will mature and require refinancing around 2026. To understand why this matters, consider how government borrowing works. When Treasury securities mature, the government issues new securities to replace them. This process keeps the debt market functioning smoothly. But when a large amount of debt matures within a short period, markets must absorb a surge of new supply, and that can influence interest rates. Higher supply of bonds can push yields upward if demand does not increase at the same pace. Rising yields mean higher borrowing costs for the government. But the effects do not stop there. Mortgage rates, corporate loans, and many other financial products are linked to Treasury yields. So when Treasury yields rise, borrowing costs across the entire economy can increase. Another factor is fiscal policy. The United States continues to run large budget deficits, meaning the government must borrow additional money every year. That no borrowing adds to the total supply of Treasury securities entering the market.
So by the time 2026 arrives, markets may be absorbing both refinancing debt and new deficit financing. This combination creates what some analysts call a debt wall, a period where large amounts of debt must be rolled over while fiscal pressures remain high. However, there are also stabilizing forces. Treasury securities remain one of the most trusted assets in global finance. During times of uncertainty, investors often increase their holdings of treasuries rather than reduce them. Central banks still rely on U.S. government bonds as reserve assets, and global financial institutions depend on the liquidity of the Treasury market. These factors help maintain strong demand even during challenging periods. So the refinancing wave does not necessarily mean a crisis, but it does represent a moment when market dynamics become especially important. Interest rates, investor confidence, and global demand will all play critical roles. In many ways, the story of the $7 trillion refinancing wave is not just about debt. It is about how modern financial systems manage risk, liquidity, and confidence. And the way markets respond to this challenge could shape economic conditions for years to come.